Welcome back, everybody. Stephen Morris here with Advisory, and we are approaching the year end, and I thought I'd spend a little bit of time here to give you some predictions, some ideas, some other thoughts I had about what's going to happen in 2025 as it relates to real estate and some changes in the tax laws as well. So with no further ado, let's jump right into it. Let's start with housing and the rental market. As we know right now, rents are sky high, home prices are also sky high, and it doesn't seem like there's going to be any indication that this is going to change sometime in the future. With interest rates continue to be where they are, and even if the Fed lowers them a little bit, we expect to see interest rates continue to be much higher than historical averages, especially considering the fact that most of us in this country are sitting on loans in the 2 to 3% range and have no incentive to properly leave their homes at this time or sell or dispose or do any of that sort of stuff to get out of their properties. Since we know that home prices are sky high right now, you would assume that there would be developers willing to step in and build a little bit more inventory to be able to sell to the market. Unfortunately, as it stands right now, construction costs are probably the highest they've ever been in history, and there's a lot of reasons for that. Number one is we have this historical shortage of construction labor, primarily informed by the Great Recession back in 2008, when a huge plethora of construction professionals actually exited the industry back when the times were absolutely horrendous. To that end, we haven't really resupplied or really encouraged the development of trades in the United States for, call it, the past 10 plus years. Only now we're starting to see folks enter into the trades doing things like plumbing, electrical, carpentry, all that sort of stuff. That's going to take years for us to eventually see it make its way into the market. And so for now, we currently sit on a labor shortage. Couple that with the fact that there is a significant demand for construction, especially after the Inflation Reduction Act of 2022, which called for tons of money to be used towards public infrastructure across the United States, drawing from these trades from all around the country. Add on top of that, there's a desire to build more car manufacturing facilities. You're talking about a ramp up in AI. You're going to start to see more data centers start to come in. There doesn't seem to be any slowdown in terms of construction demand. These same trades, whether they're building bridges, roads, highways, data centers, EV car manufacturing facilities, would also be used to potentially build housing. As a result, we're not going to see any relief and pressure, in my opinion at least, to the housing market construction for quite some time. And as a result, we're probably going to continue to see a lack of incentive, a lack of desire to produce more housing until we see either costs come down or price move up significantly much more, which would be tough to argue considering the fact that perhaps incomes aren't as growing as quickly as they have in the past. So with that being said, it's tough right now to get into the market. However, if you're a current holder of an apartment complex or you're currently owning your house right now, you're probably in fantastic shape, and I would recommend holding for quite some time, considering the fact that you'll probably see some level of rental growth. And if you're in places like California, although some expenses like insurance are moving up, your real estate property taxes are most likely going to stay flat, or they might move up just a couple percentage points due to the state law. Let's move on to another sector that has me very interested, and let's talk about office. So, as you may know, at the time of this video, people are very interested in working from home and not going into the office. As a result, vacancies in offices have absolutely skyrocketed. And there's actually a tale of two different office markets going on right now in the United States. The first one would be in primary markets in primary locations. So if we're going to use Los Angeles, for example, a market I'm very familiar with, we have Century City, which has absolutely gone bonkers, and you're talking about sky-high rents and very, very low vacancy rates. Simultaneously, about 8 miles east, you're talking about downtown Los Angeles, which has experienced absolutely horrendous times with very high vacancies. Rents have had to be dropped, and you're starting to see a lot of the landlords hand back their keys to the banks because they can't afford to service the debt any longer. Recently, we've seen some transactions in the office sector trading at prices that you just would not believe. I mean, we're talking between 60, 70% off what they paid for it 10 years ago. And under today's market, under today's construction costs, you can't even build the first 3 floors of that building for the price that they're paying for their construction right now. And so in my opinion, there seems to be a very good play here in terms of buying office, because I can't imagine it going down any further. And so at this point, you probably are buying at the bottom. And if you have a long-term hold strategy, maybe in the next 5 to 10 years, you would see your investments start to skyrocket. Now, the main question you might be asking is, how do I get into an office building like a Class A building in downtown Los Angeles that trades for $140 million? I don't have $30 or $40 million of down payment, or even $50 or $60 million to do the transaction.
Close, but no cigar.
Well, I would recommend looking along the lines of buying into REITs that hold office buildings, or there might be some private syndications that are interested in buying into the office space. You might want to look into those and have a very long-term hold strategy. My recommendation is don't count on that money for the next decade, but you probably will be very happy in 10 plus years. And so the question is, why am I so gung-ho on office buildings?
Oh, yes. Do tell us.
Well, for a number of reasons. Number one is some of these buildings, depending on the size and the profile of the building, could be repurposed into multifamily in the future or some sort of mixed-use development. And that would be fantastic as a revitalization tool for the cities, especially as city governments would like to see those office buildings reutilized and not sitting there vacant, which would cause eventually blight and other certain bad economic conditions in those areas. And so you might see them start to provide some sort of tax incentives or even some sort of direct financial incentives to get these properties to be redeveloped. At the same time, we're not sure where the market will be headed. There is a growing demand to have a return to office mandate, especially from employers, and you might see that office demand would start to pick up in the future, especially as more and more companies are requiring their workers to go back to the office. So stay tuned for that, but I'd strongly recommend taking a look at office as a good investment opportunity right now. Let's shift gears over to taxes. Now that Trump has won the presidency, we're probably going to see more of the Tax Cuts and Jobs Act of 2017 renewed, expanded, and one of the things we're heavily expecting as tax professionals is a revamp of the bonus depreciation. Right now, as it stands for 2024, if you place any equipment or property into service for trade or business that has a 20-year or less life, it is eligible for, as of today, 60% bonus depreciation, with the remaining 40% to be depreciated over its useful life. Next year, by the way, 40% would be the number for tax year 2025. Most likely, it'll be reset back to 100%, and you'll start to see these huge depreciation deductions, especially as it relates to cost segregation studies, start to come down the pipeline again. The future Trump administration has telegraphed that they would like to cut taxes, and so the bonus depreciation law would be one of those things that he most likely will implement. And of course, as you may have heard, the EV credit might be going away. As of the time of this video, the EV credit is substantially helpful, but it's not as great as it used to be. Most likely it'll be cut in the coming year as they're starting to have an administration that's a little bit anti-electric vehicles. We as tax professionals at this point are really unable to predict exactly what's going to happen, as so many things are subject to change. You still need congressional approval, and the president has to sign it. And so far, the president hasn't given us any concrete guidance on what he plans to implement when he comes into office.
What do you suppose I do in the meantime?
Since we're unable to predict what's going to happen in the future, I would recommend taking steps to diversify and spread risk. One of the things that we propose here at Advisory is that you obtain multiple residencies around the world and park your money in different countries, also investing in real estate in other countries to spread the risk. Some of those countries could include things like the United Arab Emirates. We're very big now on Saudi Arabia, as well as countries like Paraguay, which are great for residencies and also are growing in demand and popularity, especially in Europe. Here at Advisory, we're a huge proponent of obtaining multiple residencies. Why? Number one is you can spread your risk by having your assets parked in different countries, thus taking some of that risk off the table as it relates to what might happen in the United States in the future. Number two, it opens up investment opportunities for you, especially as it relates to real estate. Typically, you might need a permanent residency or even a citizenship in some of these countries in order to legally own property. These type of ventures take quite some time, and they take several years in the making before you can obtain them. The best time to start those is today, not in 5 or 10 years when you're actually considering the change. Lastly, you get to experience different qualities of life. For example, the cost of labor in some of these countries is way lower, and you're able to afford services that may not be typically available to you in the United States. We believe residencies are just a great backup option for you should situations in your life change, and you might have these options down the road later on. As I mentioned in the video link below, these visa opportunities are not available forever. They can change at any time depending on immigration flow and also public sentiment. And at some point, they might revoke the opportunity for you to obtain a residency or even a visa in the country, which would then limit your choices down the future. So in conclusion, housing is going to stay persistently high. We don't really see interest rates dropping substantially in the next year. Office might be a good opportunity at the right price. We'd also recommend considering tax law changes, bonus depreciation most likely is coming down the pipe. So if you're considering buying equipment, it might be better to wait till next year, or if you're considering buying an apartment, it might be better to wait until 2025 for the purchase when it's placed in the service at a 100% tax rate. And finally, as a general overall backup plan, we always strongly recommend obtaining multiple residencies and diversifying your assets outside the United States to spread the risk and to give you peace of mind for what may come in the future. Thank you so much for watching. I hope this really helped out. And if you'd like to reach out to us for any questions, or if you'd like to learn a little bit more about why we said what we said here in this video, then feel free to contact us here at this email and we'll be more than happy to respond to you. Thanks so much for watching.